Hello, good evening, and welcome to this edition of IG Live. We are 10 minutes away from the interest rate decision from the US Federal Open Market Committee. The voting members have been casting their votes on whether or not to raise interest rates at the top of the hour. There's some interesting developments under the covers, and I think we've really got to be aware of what's happening in order to work out precisely what it is the Fed's going to do. The Fed is forecast to pause after 10 straight meetings at which it's jacked up its key rate by a total of 500 basis points. It's gone from nothing to 5% or 5%, 5 to 5.25% range. Economists do see this meeting as an opportunity to pause. The pause is needed, according to economists, because there is a need for the Federal Open Market Committee to witness just what's happened in terms of where we are and the effect that this monetary policy has had, this tightening has had on the economy. I think we've got some illustrations for you just to show you what's going on. The CME FedWatch tool you can see here points to a 25% chance of a 25 basis point hike. In other words, there's a 75% chance that they will not be moving at this meeting today. Latest inflation data published yesterday confirming that a pause now hike later is expected. US consumer prices, the CPI yesterday being published, decelerated more than expected on a year-over-year basis. Now, the headline CPI rose by a margin of 4% in May, year on year. Now, this is the smallest increase in more than 2 years. You've got to go all the way back to the first quarter of 2021 since you get back to these sort of figures. It is undeniable that the effects of the Fed rate hikes are felt more and more, justifying a pause, according to many. However, core CPI remains sticky. Now, we talk about sticky inflation. Inflation is hanging around if you look at the core numbers. The core numbers don't include food or fuel. Now, all this coming in line with expectations, up 5.3% year on year, 1.3 percentage points higher than the headline CPI, which suggests that the tightening cycle isn't over yet. So we've got to work out where the next interest rate rises or when they're going to come. It certainly seems like the Fed has got a balancing act on its hands over this meeting, and there will doubtless be some interesting headlines coming through at the top of the hour. I think in amongst some of the other headlines to watch out for are the economic projections. This is a big Fed meeting, and it comes out with some new thoughts on where growth is going. It's going to come out with some new thoughts on where inflation is going, and that too could be key in putting together the thoughts for the next meeting. The next meeting's at the back end of July. Then you've got to wind the clock forward all the way to September for the meeting after that. And then you get into the autumn, and a whole new set of economic dynamics could, by that time, be developing. As over the summer, things do happen that maybe might all of a sudden come out of the covers. Well, let's take a look into some more detail now with a more intelligent view of all this than I can deliver. And we're off now to Daily FX and join Richard Snow, who joins us, who's a Daily FX analyst. Rich, good evening to you. What do you think the risks are here? I was talking there about the CME and this 25% chance that there's going to be an interest rate rise, which means the balance of opinion, the majority seem to indicate that we're going to get no move today. Put some more flesh on the bones, if you can, for us and work out where the trades are going to be.
Hi, Jeremy. Yes, market consensus is very much in line with a no hike scenario, or as the Fed likes to call it, a skip that we're going to see in June potentially. Looking at the way markets are positioned in this, we've actually seen positioning move even more strongly towards the camp that we'll see no hike. And that's after we saw some encouraging PPI data. That's another inflation metric, more along the lines of what we're seeing out of factory gates before it filters its way down to the consumer. So on top of encouraging inflation data that we had yesterday, as you mentioned, we're also getting positive producer price inflation data on top of that. Essentially what that's done ahead of the FOMC is accelerate some of the recent directional moves we've been seeing, particularly in the FX market. And I'll just take a look at euro dollar. We saw quite a massive move to the upside. And you mentioned the risks of this trade. Well, when sentiment is so heavily in one direction, there's always an opportunity for repricing to take place. So at the moment, markets are heavily expecting the dollar to remain fairly weak. They're not anticipating a hike. If indeed, for whatever reason, we do get a hike, we could see quite an aggressive retracement of the daily move thus far, and that move has been quite significant here. Just taking a look at another currency pair, if we look at cable, we're seeing, again, it's really kicked off this afternoon. We're now trading up towards this zone of resistance around 1.27 and looking to make some fresh highs there. Cable is an interesting one. We have the Bank of England obviously next week giving their rate decision, but at the moment we're contrasting these reserve banks that are still on their way to the top of their rate hiking cycles, whereas the Fed appears to be reaching its terminal rate fairly soon. Speaking more along the Fed interest rate decision tonight, we obviously get the summary of economic projections, and we could be looking at the terminal rate to see if there is a movement above 5.1%, where the committee currently sees the terminal rate. So if we see a move higher there, that would certainly indicate that we could be seeing another 25 basis point hike before year end. But at the moment, this is where we are poised heading into the announcement.
Let me just quickly pick up, if I can, and take a look and ask you to take a look at the equity markets, because I think there's been, we've been talking about this in the early morning call, this massive rise we've seen for tech stocks particularly, where I think now the index is showing us with a 40% gain from the start of the year. I know, look, the breadth is so narrow. It's just a few relatively large heavyweight stocks that are doing the heavy lifting here. But nonetheless, it's lifting the index. A lot of people are saying, how much higher can it go? If we do see the Fed start to come back in and perhaps maybe even give us some sort of a hawkish tilt to the commentary today, that could potentially, as you say, unwind some of this euro-dollar trade we've got, and I imagine would have a potentially negative effect on equities. Thoughts?
I mean, the way you're looking at this price action here, it really does look unstoppable. You tend to gauge a bullish trend by the depth of the retracements, and we've hardly seen any. That chart's pretty much been up and to the right. And if we are to see a change in expectations, or the Fed coming out with a surprise hike, yes, I believe we could see a move lower, but it doesn't appear that that would see a reversal in direction. I imagine that would still just be possibly a better entry level for bullish continuation plays at the moment. It just appears as if this index market is fairly unstoppable, but the risk here is we are in overheated territory. On the RSI, we're trading well into overbought territory, and there are a lot of risks with chasing bullish markets, particularly when they are as overheated as this. But yeah, if we do get a surprise, we could be seeing prices coming down in the short to medium term.
You mentioned Bank of England. Of course, the context of other central banks is important. We've got the Bank of Japan, of course, on Friday. I know it's not expected to move, but we'll talk about that a bit later on if we get an opportunity. But I don't want to major on that. But I think that move we've seen against the sterling dollar move. Let me just quickly bring my chart up, because you correctly pointed out we've got this break of this line of resistance that we had, which was established with the high on the 10th of May. And in fact, you can see on this chart here, we've gone all the way back to the 26th of April, 2022. We've got an upward facing momentum curve. Momentum would seem to be on the side of the Bank of England. In other words, the Bank of England is, I know, according to some reports, possibly got 100 points in the bag, possibly 150, according to some very hawkish economists. And clearly there is potential. Why is it in this side of the Atlantic, or certainly in the UK, we're finding it difficult to establish the bottom in inflation, but they seem to have conquered it in the States?
Well, a lot of what we're seeing right now is the wage pressures that are coming to the market. We've seen that print just this week with the employment data, is that wages are continuing to grow higher, beg your pardon. And the Bank of England is certainly fixated on ensuring that prices head lower. We've only just recently moved below that 10% mark and hoping for more of a reprieve as far as inflation is concerned. But the energy prices was a big factor, but we still seem to have that inflation taking place throughout the wider economy and just really struggling to bring it back down.
Yeah, look, Rich, stay there. We're just getting the breaking news headlines coming through any moment now. Let me just quickly bring up my chart here, euro dollar trade. This is a 1 minute chart here, which shows you candles by minute. Right, we got the decision count coming through. It is absolutely as expected. It is a 0% surprise. It's exactly where we were expecting the figures to be. Interesting enough, we've got some projections coming through on the expectations for consumer price inflation and some of the GDP numbers. Let me just quickly take a look in some more detail about what's been happening. Policymakers see higher GDP growth in 2023, a lower unemployment rate, and less progress on core inflation than they saw in March. Now, this is going to be a problem. We were talking about the stickiness of inflation, and I think that is something which we are going to have to think about more and more, is the fact that the Fed is concerned about the idea that inflation is not going to go away. The Fed sees two 25 basis point rate hikes by the end of the year. Nothing new here in terms of projections. It's holding its target range steady at the meetings, allowing time to assess additional information and implications for monetary policy. It says that inflation remains elevated. Looking at this chart here, look at what's happened here. We've got the euro down. Now this, as we've been saying, and Richard was talking about here, is a reversal of some of the activity we've seen. Bearing in mind, this is just a minute-by-minute trade. So if I go back to the day-to-day, you can see that in the grand scheme of things, it's really done very little. It's taken the froth out of the market today, but we are still higher than we were this time yesterday. The key interest rate left unchanged, as I said. The Fed holding a target range steady at this meeting. The other headlines that we're getting through. Banking system is sound and resilient. Now, this is critical. We've been talking about the potential downside for possible equity markets. If we saw any frailties in the banking sector coming through, that would be a problem. The Fed says tighter credit conditions for households and businesses likely to weigh on economic activity, hiring and inflation, but the extent of effects remains uncertain. Again, this is why the Fed has left interest rates unchanged at this meeting, because it wants to assess the damage, if you like, for want of a better word, and certainly the effects of this tighter monetary policy. The Fed says it's strongly committed to returning inflation to its 2% objective, but at the same time, it says it is concerned about the fact that inflation is hanging around more than would normally have been the case at this time, at this part of the cycle, bearing in mind what's happening. Let me just quickly go on to what's happening with these tech stocks, because I think, again, looking at what's going on a minute-by-minute basis, just to get an idea as to what the effect of this has been on the Nasdaq, for example. You can see a pullback, and now we're beginning to build some positive positions after having gone all the way down to the lows down here at 14,850. We're back at 14,873. Again, not much move in terms of the grand picture. These are minute-by-minute charts. The Fed said the vote was for policy today was unanimous. And the point of order, if you like, and what they want to get the markets to understand that they can see, is that they don't see any real cracks appearing in what they've done so far. The Fed projections imply, as I say, 2 more 25 basis point hikes this year and 100 basis points of cuts in 2024. I don't think I've seen that before. I'll ask Richard about this in just a minute. Policymakers see higher GDP growth in 2023, a lower unemployment rate. We've been through all that. So you can see that the Fed is fairly happy with where they are at the moment. And the position, I think, where they are means that they have done pretty much what they want to do at this stage. They do see more interest rate rises to come, depending on the stickiness of inflation and where that goes and what's been happening there. Let's bring Richard Snow back in and talk a little bit more about the effects of all that's happened. I mean, you've been watching the headlines as I have, and it seems to me, at least, to be clear that the Fed's happy with what it's done so far. I think Jerome Powell will be quietly encouraging people to pat themselves on the back because they got to where they are. The economy hasn't fallen apart. They're talking about the banking system remaining resilient, and we don't seem to have got too much of a move on the market. Now, from a trader's point of view, that's not good news, but on the long-term investment point of view, what do you make of what we've heard today and where the Fed is and what they're planning?
Well, pricing in another 25 basis point hikes, that's, going to add to your dollar valuations, likely to see dollar moving up. You could possibly be seeing that in your yields going forward as the market's now priced that in. We obviously were anticipating that we could be getting another 25 basis point hike. It wasn't certain as to whether or not we get two, but I think you mentioned at the start of the show that the Fed was looking to strike a delicate balance. And I think this statement really just appeases those hawks that are still within the FOMC committee in that, they see GDP actually increasing, they see unemployment decreasing. Those all speak to the fact that the economy is still growing stronger and that more is yet to be done from the Fed's point of view. So yes, we didn't see a hike this time around, but that hawkish side of the statement and also the summary of economic projections, that certainly suggests that this fight is far from over and we could still be seeing the dollar moving higher.
Okay, let me ask you to bring up your chart for euro dollar, because you were talking about the possible potential for a retracement if we got a particularly aggressive Fed. We haven't got that. We have seen a little bit of a pullback in that euro dollar rate on a day trader basis. You've got a little bit of a bite in the downside. You've got the daily charts there, and like what I was just saying, you've got that long upside candle, which to me indicates that the markets are off the top and looking as though they could want it. But in fact, look, this uptrend is still continuing. Is that the trade you think we should now be following? It certainly seems like that little symmetrical triangle, that pennant has now been sort of exorcised, if you like, and I think we got that break to the upside. Much more upside to go for euro dollar?
You would still think so. I am of the opinion that we could still see euro dollar trading higher. As I mentioned, they're in different stages of the rate hiking cycle, the Fed and the ECB. The ECB still looking to hike more. Although having said that, we're looking at 225 basis point hikes from the Fed. So it could be quite choppy from here on in. And FX markets in particular have been extremely sensitive to incoming data. So that really doesn't help from a trend trading point of view. But I do still see the potential for more upside in euro dollar. Yeah, as we said today, we didn't see a hawkish interest rate announcement, but the actual statement and the projections were in fact plenty hawkish, and that's why we have seen this intraday pullback as aggressive as has played out.
And I suppose really, I've got to ask you the same sort of question on what's happening on the equity markets. We were talking about that massive run that we've had recently on the upside for tech stocks. The Dow and the S&P 500 as well have taken part in the recent rallies. There's got to come a point, I guess, if we're going to see. I mean, they're saying there's no sort of cracks appearing, so I guess there's no reason why you shouldn't keep that trend going. But one can't help but feel a little bit vulnerable as you see this market move as high as it has done on so few stocks.
Yeah, exactly. It's just been a handful of stocks that's really been dragging the rest of the index higher. As I mentioned a little bit earlier, if we do see somewhat of a pullback here, which appears to be developing, and actually on the RSI, we're seeing prices.
What chart is that? What chart is that, Rich?
This is the US 500 or the SPX.
Okay.
And yeah, certainly retracing a lot of what we'd seen previously. And yeah, like I said, it appears, according to the trend, that this could possibly provide better entry levels for bullish continuations. If there is to be a reversal, we'd certainly need to see a much deeper pullback. You're perhaps looking at a retest of this February high, just south of 4,200. So you'd really need to see extended selling from current levels to at least entertain a much shorter view on equity markets. But for now, you would anticipate some sort of a minor retracement, but certainly have to watch that as it unfolds.
Yeah, just one final area. I know that clients love gold. We always get questions when asking clients what they want us to talk about. Gold is always in there in the mix for where it's going. I notice actually that the gold is at the bottom of its candle today, and that's moved in the last short distance. Let me just quickly, while I've got my chart up here in front of me, I just want to take a look at the minute-by-minute candle just to look at what's been happening there. You can see quite clearly the effect of this decision today. What's going on under the covers for gold? We quite often talk about gold moving in the opposite direction to the dollar, which, I mean, it's a bit difficult because the dollar's been moving sideways. We've little sort of bite either direction for gold. Thoughts and analysis on what's happening with precious metals?
Your precious metals, the shock that we had with the regional bank instability, that's sort of subsided for the time being. Gold pretty much trading sideways within a broader channel. And if we are seeing dollar strength, we saw euro dollar pulling back. So dollar getting a bit higher, that tends to make gold more expensive for your foreign buyers. The fact that it's been priced in gold. Yeah, we'll basically take a look at this and see if we are to breach the level of support around 1937, well, then could be moving lower, but a lot of that will depend on dollar valuations going forward and US yields, you'd imagine. But if there is any more talk of your banking turmoil coming back to the surface, well, then we could still see some value for gold. So again, it's just one of those things that keeping your ear close to the ground as far as breaking news is concerned. The Treasury Secretary, Janet Yellen, certainly mentioned that more mergers are likely. And if we are seeing tighter policy going forward, then that certainly adds stress to that scenario.
Yeah, you're right. I mean, pointing out gold is priced in dollars. You've got to take a currency risk if you're going to buy and sell in dollars. And of course, in local currencies, it can be very differently. And indeed, of course, has been at record highs recently again in sterling at some point in the last 6 months. Let's just move the pointer on to tomorrow, because we've got the European Central Bank meeting. Well, the meetings have been going on today. They'll go through the morning tomorrow with a decision at 1:15 p.m. UK time. Now, your colleague, Nick Corley, will be with Angeline Ong on this platform tomorrow to discuss that. But what are your thoughts? What do you think we'll be hearing from the ECB tomorrow that could give us traders a steer on this bullish euro-dollar trade? Do you see that continuing throughout the decision tomorrow?
I think there's a few headwinds to that potentially. The fact that the Eurozone has dipped into a technical recession, we'll have to see whether that factors into the committee's thinking. We understand that they are anticipating a hike, and that's essentially the angle I'm looking at it from, is that we are expecting further hikes from the ECB, but it all remains how attentive are they going to be to the fact that we're in a technical recession right now. You'll remember when the US dipped into a technical recession, no one really paid it much notice, and that's because employment, or unemployment, I should say, was extremely low. So there are a number of headwinds that could potentially come into play with the ECB tomorrow. Yeah, as we say, looking for 25 basis point hikes there, and we'll see how that develops.
Let me just bring up this chart here. This is a 24-hour chart on the IG platform for the German DAX. And in fact, some have noticed, look, I do the early morning call, so I get up early and we assess what's going on in the day. And something I've just noticed actually today, we've seen a new all-time intraday record high on the German DAX. That doesn't look to me like a market that's worried about the direction of interest rates. I don't know if you've got any commentary about the German DAX, but it is, in that respect, far further on than the US markets are, because we've got these new record highs. What's going on? Because you mentioned the Eurozone, this winter recession. Germany has been in recession. Okay, it's recovering now. We've seen some economic evidence recently this week suggesting that things are beginning to warm up a little bit. But this is an economy in recession, and we're still getting record highs on the benchmark index. Thoughts?
Well, you can't separate this from what we're seeing in US indices. You know, when the US rises, it tends to be that rising tide that floats all boats, so to speak. So you tend to get that knock-on effect in Europe as well. Looking at the China story, China is quite a big influence in the German economy as well as the rest of the Eurozone. So the fact that we've seen some looser monetary policy moves from China recently, their short-term lending rates, they actually dropped those, and there could be a view for further drops, and that's essentially to support their economic recovery. And data thus far has been quite mixed, particularly when you're looking at their manufacturing sector, and that being the dominant sector there. So I think positive news from China has now overflowed into the DAX markets. And of course, you have that positive sentiment from the US equities edging higher, and that's certainly playing a part in this rise here.
Yeah, look, Richard, it's a pleasure. Thanks indeed for joining us. Looking through the Fed's announcement today, that's Richard Snow from Daily FX. I just really wanted to wrap up things, and I wanted to show you this chart here. This is the euro-dollar chart on a one-day chart, and as Richard was saying, we've got the European Central Bank meeting tomorrow. Just to look at this chart and consider, the Fed officials leaving interest rates on hold today on the hope that inflation will still cool. But they have their concerns about this. They said the foreseeable inflation pressures continuing to ease over the next few years. The projections released today, these quarterly projections, came as part of the Fed's Open Market Committee meeting. They see interest rates being held steady for the time being at least. Officials now expect the Fed funds rate to top out at 5.6% this year, implying 2 more 25 basis point increases this year, up from the 5.1 they projected the last set of forecasts. Officials see the target rate going down in 2024, sliding down to 4.6% against the 4.3% forecast in March. So they're looking at interest rate cuts next year. Fed officials maintaining their long-run projection of the federal funds target at 2.5%, where it's resided almost without change since about 2019. I think the policymakers have been more upbeat about the economic outlook this year and expect the job market to endure smaller job losses compared to the March outlook. So I think steady as she goes, the Fed can't help but think that they've done a good job. They held this time. They wanted to see what damage or what effect the tight monetary policy has been doing. And as Richard was saying, this trend at the moment at least is continuing for a strong euro against the US dollar ahead of the interest rate meeting tomorrow from the European Central Bank. As I said, that tomorrow we will be live at 1:10 UK time on the IG platform. Angeline Ong will be talking to our colleague Nick Corley from Daily FX, taking you through that decision on interest rates from the European Central Bank. That's it from us. I'll be up first thing tomorrow morning. Hope you can join me 7:30 for the early morning call for IG clients.